British pound hitting an all-time low today against the dollar. 1 pound equaling about $1.03. It's now back up to like $1.07.
Last week, the British pound hits an all-time low against the dollar in its history. As the fourth most traded currency in the world, it had declined more than 5% in one day. The crash has threatened to blow up nearly 50% of nations' private pension savings across the UK. Here is V-Circle. In this episode, we'll take a look what has happened in the UK recently and what will happen in the future. To get the full picture, we have to go back a few months. Here's how the UK started this crisis. 2022, energy prices are rising globally. In the UK, the inflation rate hit almost 10% in August, the highest level in 40 years. Amongst this backdrop, the newly appointed Prime Minister Truss unveiled two policies that were originally intended to stimulate the economy. The first policy announced in September 8 was the Energy Price Guarantee. The aim was for the government to cap the average household's energy bills to around £2,500 a year for the next 2 years. The scheme is expected to cost the government £100 billion in the first year. The policy will be funded by government debt in the form of bond issuance. Thereafter, the second policy was announced by the new Finance Minister Kwasi Kwarteng on September 23. A historic tax cut package for individuals and companies aimed at alleviate pressure and boosting the economy. The policy will be funded by government borrowing and is expected to cost an additional £45 billion. For these new policies, at first glance, it seems that they are aimed at protecting poor people and boosting the economy, but why is the British bond market facing a catastrophic collapse? First of all, is it really the poor who benefit most from such a policy? The data shows that the energy consumption of the poor is much lower than that of the rich. The rich will benefit much more than the poor here. At the same time, it will also stimulate the rich in disguise to use more energy and the poor to use less energy. Second, is such a policy really enough to stimulate the economy? Mr. Dalio said in the interview that such a policy cannot really stimulate the economy. The British government simply does not understand how the mechanics of the market. He also said, "I can't imagine that this is intended, and if it's not intended then it's an understanding question, which also portends the incompetence of the government." Why does Mr. Dalio scold the government for incompetence? He asked, "That policy makes people want to get out of the debt and currency. I can't understand how those who were behind this move didn't understand that. It suggests incompetence." In the basic principle of supply and demand, when supply in the bond market largely exceeds demand, price falls. So who wants to keep putting money in the bond market when you know prices are going to fall in the future? Quite simply, new investors won't come in, and old investors will rush to sell bonds. That's how UK bond prices fell. When the bond price dropped, the cost of government financing will rise. It has risen from 1% to 4% since January this year. Then you may ask again, the government gives you an interest rate of 4%, which looks good. So why don't you buy it? Now the UK has another problem, the depreciation of the pound, or called the currency depreciation. With the start of the hot circulation of the US dollar, the US Federal Reserve raised interest rates, and the global currency began to flow back to the US dollar, which led to the depreciation of non-US currencies. British pound is also not immune to bad luck. In an environment where the value of the pound continues to depreciate, what does this mean? Who takes the money to buy British government bonds, and who loses money? Why? This involves a called currency carry trade. When the GBP over USD exchange rate remains unchanged, we assume that Mr. Potato can raise $1 million from a US bank at 2% interest rate, then buy British government bonds to obtain a 4% interest yield, thus earning a 2% difference. However, this is with the exchange rate unchanged. Now if the British currency keeps depreciating, assuming that after 1 year, the currency has depreciated by 10%, the actual depreciation this year is about 22%, if you want to exchange the dollar back, you will only be able to exchange it back to $936,000, and it's not enough to pay back, you lose money. So, in such an environment, who is willing to buy British government bonds? What's more important is that now in Europe, the bad inflation environment, only 4% interest rate can't keep up with the speed of inflation. Who would want to invest their money in the UK? The smart money in the market understood this, and investors began to sell off their huge sterling-denominated assets. Exchange into other currencies that offer more security. It seems that everyone knows the rule except the British government. Well, it's not over yet, as the bond market slides. Certain funds and financial institutions are getting restless. As the markets drops, certain financial institutions weren't prepared to handle such a large decline in value. This was the case for the majority of pension funds in the UK. In total, they held almost half of the private savings in the country. What happened to these pension funds? Because investment banks offered a niche financial products to pension funds, which involve leverage, which can magnify returns and amplify risks. Such leverage also required collateral, and a large part of the collateral was held in UK bonds. As asset prices started to fall due to the aforementioned policy announcement, banks started to demand more collateral. This forced pension funds to sell some of their assets to meet their obligations. Soon, the market was crowded with pension funds looking to sell government bonds as they tried to meet new collateral requirements. With less demand and more supply, prices began to plummet, throwing the entire financial system into trouble. This is the start of a doom cycle, and if it is completely depleted, nearly 50% of the UK's private savings will be destroyed. Very soon after the chaos, the Central Bank of England was forced to step in, pledging to buy £65 billion worth of government bonds within 13 days. This essentially sets a floor on the price of UK bonds. The crash appears to have been temporarily avoided. While making this video, sterling has recovered slightly and bond markets are slowly stabilizing. But having said that, is the UK economy out of the woods? Maybe not. Now that inflation is rampant, there is still an atmosphere that encourages businesses and individuals to spend more to drive up demand, thereby fueling inflation. Imports will be more expensive and energy costs will rise. There are also growing fears that inflation will prompt the Bank of England to raise interest rates further. In fact, Andrew Bailey, the central bank governor, stated that they would not hesitate to announce rate hikes when needed. This, in turn, will make it more difficult for businesses and ordinary people to borrow. Mortgage lenders have withdrawn a large number of known and available mortgages from the market. For new buyers, high interest rates make it nearly impossible for them to buy a home, and existing homeowners who remortgage finance face double the interest payments, or more. People started paying more to keep their homes. Can you imagine how long they can last? On one side is the massive outflow of money from the London Stock Exchange. On the other hand, sterling bears have already begun to take action. According to foreign media reports, the hedge fund, Blue Bay, announced that the pound has become the fund's top currency short in play, because the fund expects that the incompetence of the British authorities will be unable to prevent the decline of the pound. This reminds us of Soros's snipe on the pound in 1992. At that time, Soros also thought that the British authorities were incompetent, and betting against the pound. At first, the government continued to use foreign exchange reserves to fight back, but after using more than $26 billion, it ended in surrender. Well, today, decades later, the British government's $65 billion bailout seems to have given the bond market a kick. But the flames of crisis have not been extinguished. Will this crisis start to spread? British authority teeters on brink of recession and crisis. It depends on every steps they take in the future. If the current British government continue its incompetency, then a series of crises may on the way, like bond crises, sterling crises, mortgage crises, and even the crisis of the entire financial system. Let's keep eyes on these two major financial institutions, Credit Suisse and Deutsche Bank. Their shares have fallen 40% recently. Because they all belong to the international system of banks and have connections with other important global financial institutions. If they had a crisis, it would challenge the global financial system. But at this point, nobody can be sure, it just looks risky. Alright, so that's a lot. To wrap it up, back to the topic of this episode, I'd like to hear everyone's opinion. What do you think of the new policies of the British government? I am very interested to see your comments. We also hope to make a series of episodes related to the macroeconomics. If you like it, you can subscribe to our channel. Thanks for watching.